Hey, good afternoon, and welcome to another day of Mark Bird, brought to you by Mike Bjork. Today is Monday, March 4th. I hope you guys had a wonderful weekend here. It was a beautiful weekend here in Southern California. We had like 80-degree weather, so obviously a little bit cooler this week, but overall nice weekend. We don't have any economic news releases scheduled for today. We're going to jump right over to the headline news, which is what's moving the markets. But later this week, we do have some important economic news releases scheduled. Mostly the jobs numbers will be coming out. So we'll have the ADP coming out on Wednesday. Thursday, we'll have the weekly jobless claims. And then Friday, we'll have the Labor Bureau of Statistics coming out with their jobs numbers, non farm payrolls. So right now, as we've been doing most this morning, the stock market has been down and then it just kind of made its way upwards right now. And then part of it this morning was due to China's economy slowing down. Their PMI, non-servicing, or their servicing PMI came up, uh, decreased, and then also they came out with some more restrictive terms for home purchases, namely on the second homes in areas that have been having steep inclines in home prices. Some of the things that they're doing is the uh, requiring more down payment, regards to um, interest rates, and then they had a couple other items on there. One of the things that was on that's moving is now that kind of affected the oil market primarily because now they're figuring that there's going to be. Oh, the other item to note was 20% capital gains tax for any existing home sales on those people. So what impact that's going to have is on the oil prices. So with the second largest economy behind the U.S., showing that they're going to slow down because they're getting tougher on construction as well as expansion on the real estate. They figure there's going to be less demand on oil, so price of oils came down a little bit down today, just over a hair over $90 today. We haven't been under 90 since December, so it'll be kind of nice to see that come down a little bit. And then also later this week, we got the ECB and the Bank of England is going to announce their monetary policy. This could have a major impact of where economies are. There's some projections that maybe they may even announce because it's getting kind of difficult over there in Europe again. That maybe there might be some reductions in their interest rates. And then we also got the inconclusive election results in Italy last week, still creating some uneasiness. So what's going to happen is they're going to have another election going on, and this could, they don't know what Italy's role in the European community will uh, hold in the near future, as some of these people that were running on platforms were basically they're going to admonish the austerity measures that were put in place to make investors concerns a little bit easier concerns. Now that could be all unraveled with these elections. And also earlier today, Janet Yellen was talking out, and she's the person that could be in line to replace Bernanke as the Fed chairman, and she's out of the San Francisco Fed, and she's talking about all these different aspects for QE. So one of the big terms that you're hearing a lot now is stuff QE2, QE3. Now they're just kind of QE forever because it seems like it's been kind of going on for a long time, and they don't see any end to it as of yet, as they've pegged it a couple months ago to instead of like saying 2015, now they're saying once unemployment reaches down to 6.5, if long as inflation stays under 2.5% year over year, then they'll look at it. But and also other aspects of other Fed members have mentioned that once they do get to that point, they want to see kind of consistent basis that it's not going to once they cut it, and it's not going to go reverse on them. So they're going to probably phase it out rather than just doing one lump sum of just totally cutting cutting it. All right, so let's jump over to the bond market and see what interest rates are doing today. We start off at the 103.59 earlier today. We're down about 6 basis points, so rates really haven't changed too much. They're pretty close to what we left off on Friday, so not a big change right there. So we're still kind of in that range there, but also again we got to be very careful here as we are in the upper range. A lot of experts are kind of projecting that we could be seeing worse pricing ahead in the near term. In the long term, they're pretty bullish that we're going to have better pricing, as we've been kind of waiting for this market correction in the stock market to kind of take place, but it hasn't yet. Doesn't seem to have yet developed yet. And every time we've gotten these kind of sideways patterns, we've gone one way or the other way, and lately it's been downwards. So we do have more upside risk of seeing a little bit in the short term, interest rates maybe going up a little bit before we see them get better. All right, folks, thanks for watching. You guys have a wonderful day. We will see you guys tomorrow. And if you guys like to receive these videos on email, just stop by mikesdailymarketreport.com. Upper right hand corner, you could subscribe. We don't share your information with anybody else, nor do we send you any other emails, but just these videos. Have a wonderful day.